All right, now we will look at the question number 2 from the March July 2021 exams. Okay, so firstly, before looking at the introductory part, we will look at the requirement. What the requirement saying in relation to the matters described in exhibits 1 to 4, comment on the quality of the planning and performance of the group audit and the audit comments of the group, discussing the quality control and other professional issue raised in respect of Cameron Company, Mast and Company, Dean Company, Horner Company. Right, so we have 8 marks for the first one. We have the second. For the second, we have the 5 marks, and for the third requirement, we have again 5 marks, and for the last, we have 7 marks. So let us move to the introductory part. It is 1st July 2005. You are an audit manager in James and Company, a firm of chartered certified accountants. Your role includes performing post-issuance audit quality reviews, and you are currently reviewing the audit of the bond group, the group which had a financial year ended 31st January 2005, and in respect of which an unmodified audited opinion was issued last month. The group supplies computer components specializing in graphic cards. Okay, you are reviewing the group audit file as well as the audit file for 4 of the group subsidiaries. All 4 of these subsidiaries are significant component of the group and a financial year ending 31st January 2005. Okay. Each subsidiary audit opinion was also unmodified. You have seen provided the following um, exhibits which provide information about the bond group and the points you have identified for each subsidiary in the group. So Cameron points have identified from your review of the information provided by the component auditor. So let us look at the Cameron first. Exhibit 1. Your firm audits all group companies with the exception of Cameron Co., a subsidiary which was acquired during the last financial year. Okay. Cameron Company was acquired by the group in April X4. Okay, and it's audited by Carey Associates, a small or local firm. Cameron Co. also outsources its internal audit function to Carey Associates. The section of the external audit working papers provided by Carey Associates and relevant to internal controls contains very little documentation. Number one issue we found already. We found, despite we found 2 issues. Internal audit has been outsourced to Carey Associates. Okay, so they are carrying out the audit as well as they are providing them the internal audit services. Issue number one. Issue number 2 is related that they contains very little documentation. Then a cross-reference to the files maintained by the internal audit and a statement that we can rely on the internal control as they were tested by our firm in May X4. Okay, so there is a statement that they can rely because they were tested by our firm in May 2004. So they carrying out the test of internal controls themselves and totally reliant on them. That means if there is any errors, they have ignored. So there's the issue number 3. In respect of the Caro Associate, the group audit working papers contain the following statement. Our firm can rely on work of Caro Associate as one of the James and co-audit partners left the firm to become an audit partner at Carey Associates. Another issue of the audit partners that which were James and Co. audit partner left the firm to become an audit partner at Carey Associates, and he was involved with the audit of Cameron Co. So they are relying too much. Again, the issue we got here, it is issue number 4. Then, other than some background about Carry Associates, which had been printed off from the firm website to provide background information, there is nothing else on the file relation to the firm. Okay, not much background information other than the information from the website. Another issue, now issue number 5. The group audit working paper also includes a note relating to the consideration of the Cameron Co into the group financial statements. Cameron Co prepares its individual financial statements using accounting rule, which is allowed under national regulations. It does not use IFRS standard, which is applied by the rest of the group. The group audit partner commented in the working papers that local accounting rules are very similar to IFRS standards, so there is no need to perform any additional work in relation to the consolidation of the Cameron Code due to using different accounting policies to the rest of the group. We got another issue over here, right? So for 6 issues we got, and that would be enough to score 8 marks. So let's go and dive in for the this part of the question. So what we will first we will give the heading. Cameron Company. There are problems indicated by the review in relation to both the audit of Cameron Company's individual financial statements by Carey Associates, and in the way the group auditor has dealt with the issue of there being a new component auditor involved in the group internal audit. First, it is not appropriate that Carey Associates have relied on the work performed by the internal audit team a significant self-review threat to the objectivity of Carey Associates arises from the firm providing both internal and external audit services to Cameron Co. The IESBA suggests the IESB code suggests that providing an audit client an audit line with an internal audit service creates a significant self-review threat because in subsequent events, sorry, subsequent audits, the audit team will use the internal audit work performed, leading to potential over reliance. There is therefore a risk that the audit has not been performed with the sufficient objectivity and professional skepticism. Okay, skepticism. Okay, further what we'll say. Further, it is not clear whether appropriate safeguards are in place to reduce the threats to an acceptable level. For example, by ensuring the two services were provided by separate teams. Okay. Further, what we will say that there is a risk that insufficient audit evidence has been obtained over internal controls. This is a breach of ISA 315, which requires the auditor to obtain an understanding of the internal controls relevant to the audit, including an evaluation of the design and implementation of the internal controls. It appears that this audit work has not been performed at all due to our reliance. Further, what we'll say we will say that there is further issue with the timing of when the internal controls had been tested, which took place in May 2004. The financial year ended on 31st January 2005. So it appears that the controls had not been evaluated for the last 8 months. That's too long of the financial year. ISA 330 states that if the auditor intends to rely on controls over a period of time, the test performed must be able to provide audit evidence that the control operated effectively over that period. This exacerbates the risk of over reliance as discussed above. Okay, as discussed above. All right, further what we'll say that this raises concerns over the quality of the audit which has been performed by Gary Associates, given that Cameron Company is a significant component of the group. Any material misstatements which have not been detected by the component auditor could have implications for the group group financial statements which could also be materially misstated. So then we will use the other heading, group auditor, evaluation of carry associates is my next heading. And what I'll say in it, the component made in the group audit working papers indicate that there has been no understanding obtained by the group auditor in relation to the scope and extent of the audit evidence obtained by the component auditors. This is a significant quality control problems and a breach of ISA 600 special control. Okay. Audits of group financial statements requires that the group audit team obtains an understanding of the component auditor and be involved with the component auditors, which requires that the group audit team obtains an understanding of the component auditor and be involved with the component auditor risk assessment to identify risk of material misstatement. The fact that an audit partner has left James and Co. work as an audit partner at Carey Associates has no bearing on whether James and Co. should have obtained an appropriate understanding of Carey Associates an understanding of whether Carey Associates follows the same ethical framework as the rest of the group and an understanding of their competence is required. It appears that group audit team has been conducted without this necessary understanding being obtained, which is a breach of ISA 600. Sorry. Right. Now, further, lastly, the last discussion of this part is use of local accounting rules. So Cameron Company uses local accounting rules in its individual financial statements. Which is acceptable. However, for the purpose of consolidation, the same accounting policies must be applied across all group companies as required by IFRS 3 business combination. The fact that the group audit partner has concluded no work is needed in relation to the accounting policies indicates poor quality audit work and insufficient audit evidence has been obtained. Adjustments may have been necessary to Cameron companies' balances and transactions prior to consolidation with no audit work being performed to assess whether this is the case. There is a risk of material misstatement in the group financial statements. So that's it for this part. I hope you get it. we will look at the next part now, the next video.